Hello, hello. So today we are gonna go over the next chapter, which is Volume Tells the Truth. Let me load that up real quick. Okay, let's see, is that loaded up? Perfect. So volume tells the truth. Price shows where the market went. Volume shows you why. Price without volume lacks context. Volume reveals participation. Movement requires commitment. Volume explains acceptance and rejection. This chapter adds depth to price action. Truth is revealed through participation. So, you can see this often when you look at the market and you see certain liquidity pockets that were laying liquidity or lying liquidity from past sessions. Let's say you go from the New York Stock Exchange after 2 hours close, you go to the Asian market. When the Asian market opens, you still have a lot of volume and others, actually, not really volume, but you have liquidity pockets. And these liquidity pockets can lead to increases of greater volume during those times due to orders being placed during the New York Stock Exchange or London Exchange of prices that are still trying to be sold at a certain price or prices that are trying to be bought at a certain price with limit orders. And these are also due to huge areas of delta or huge areas of options, just generally options that people are trying to play with every single day with huge pockets of options. That's where then a lot of volume out of nowhere just comes in, even though nobody's even online because we're dealing with algorithms here. So, price alone can be misleading due to these kind of things. Volume confirms or denies movement. Breaks without volume often fail. Participation defines reliability. And volume reveals institutional interest. That's the huge point of this entire chapter. This the concept filters false signals, and depth improves decision making. So, what is volume? Volume measures participation. Every contract trade counts. Every volume shows interest. Low volume shows hesitation. Volume reflects commitment. Volume reveals urgency, and participation drives momentum. So, right here, this is kind of the idea of volume, strong volume. A lot of orders come in all of a sudden, and it pushes the market up all of a sudden, very quickly. Volume can be somewhat of a crazy thing in those kind of ways where it doesn't fully give you decisiveness of get into the market right a second or do not, due to things like right in this area right here. It goes up, it hits this level, you think it's going to spike through because it's got a lot of volume, and that's most of the times that's what one wants to see. You want to have a lot of volume come into the market during a trend break or a change of structure or a break of structure, and then all of a sudden you see a lot of volume pop in. That's a great confirmation that the market will probably keep going to that way. But sometimes, and this happens actually a lot of times, the market, let's say this is a range, right? We got a range right here. The market knocks against it, knocks against it, knocks against it, goes up 10 points. It will drop back underneath it before it then truly shoots all the way up. Because there's so many orders that don't want to get left behind in that exact second. So depending on how strong the volume is, that's truly how the market will keep moving. It just has to have a lot of strong volume moments. And then you can see greater trend breaks and greater movements into one certain direction. So not much chop, breakout trades, volume very important. Price without volume. Price can move without conviction. Low volume increases randomness. Thin participation creates noise. False breakouts occur easily. Speed without volume is unstable, and context is missing. Risk increases. So the most important part here is the context of what is exactly happening. If there is a lot of volume coming in at a certain time, this is not always a positive thing. You also got to have positive delta. So you got to have positive delta, a lot of orders in those areas. Sometimes the market will just crush right through a certain area because there's so many orders, it will just go back down to that level, then want to right away go back up the opposite way because it just depends where the volume truly is. So volume is a very hard thing to study over time, But at some point, you do understand there's more buyers and sellers. Other things kind of occur in those ways, and then you have a lot of positive volume coming in, which then can lead to more decisive moves, but it can also lead to certain things like, let's say, so there are two things I would say in this kind of way. Is there's one market, in theory, the Asian market, when it's not as volatile. A little bit of volume comes in over time. You're like, okay, it's a little bit of short selling, but there's still a lot of volume. So you got 5 orders, let's say, there are shorts. All of a sudden, there's 10 buyers all the time, 10 buyers coming in again, slowly trickling upwards. And the market will just continue and continue and continue until there is exhaustion. And then, when there is exhaustion, at some point, you have reversals. Liquidity sweeps, for example, are very quick movements, volume pump upwards. And then there's so much volume in the market. So when the market's all the way up, all of a sudden it starts cracking down, going in the opposite direction, breaks through the opposite side of the IFPG, which is the next chapter, and it just starts plummeting. And that's one of the greatest patterns to learn. So volume is just super important to kind of know because you can kind of figure out what orders and stuff are. Helps you not trying too blindly. Price with volume. High volume validates breaks, acceptance becomes visible, movement gains credibility, volume follow through improves, and probability increases. Volume confirms the intent of the idea, and participation supports continuation. These are all very, very important because you want to have like probability that is mostly in your favor for A plus setup. So volume is also very important to know about. Volume profile. A lot of higher level traders love order volume profile with a little bit of delta on the side as well. It's just a beautiful hybrid. Price levels are weighted by volume. Not all prices matter equally. High volume areas show acceptance. Low volume areas show rejection. Profile reveals market preference. Structure becomes visible. Like here we can see there's a little bit of exhaustion. It goes one more time farther down. Enough volume starts coming in. It reaches this level, break of structure, place the order for a long, and it goes a little bit farther up, and that is a great trade. High volume first. High volume nodes represent acceptance. Buyers or sellers agree here. Price often rotates around HVNSs. Balance forms near high volume nodes. Breaks require off effort, and high volume nodes act as magnets. You can see this with the idea of high volume nodes, also known as like the past liquidity pockets, maybe options contracts. Like we had the huge issue of the options plays a few weeks ago when Nasdaq went up to 30,600, and the S&P was at like 47 something. I trade more than Nasdaq. That the hedge funds had huge options and kind of like iron condor plays, I guess, where it just has to stick around a certain area for a little bit longer time. And if it went up over 4759 or 308, it would have liquidated a lot of orders. So all of a sudden, the market somehow drops in the opposite direction due to hedging from hedge funds. And the options then are all taken in on the opposite side. So it all went down past 30,000 again. And then all of a sudden, it dropped 1,500 points in a single day, but it's been stuck in that area and now pushing back up to the opposite side because those orders now stacking slash hedge funds just hedging their orders now goes farther back up, and maybe they took a few of these orders out again back in profit, which would make a lot of sense. That's why it's kind of too big to fail. And markets remember these areas just as these areas, the low volume nodes. Low volume nodes represent rejection. Price moves quickly through these. And this is kind of the area where you have a lot of orders. It's just very interesting to see on the market sometimes. With order volume profile, you have like millions and millions of orders or a few hundreds and hundreds of orders, depending on which market you're actually trading during the time. Low volatility Asian markets, you see like very low amounts of orders, but it's actually quite a lot of orders. And all of a sudden the market just goes through it 60 points. I sometimes use ChatGPT for that. You like ask it, okay, what do you see in this market with all the indicators you have on the side? Same with Claude. You can use it on Top Step, for example. You can put Claude on it, just not trading view yes, unless trading view yet, unless you put something on there with some GitHub stuff, but I don't trust it as much. And then you got all this information you can get from it, which is kind of crazy. You just see like some random statement like, okay, once it breaks through 805 up to 813, then you have a bullish signal, and the levels between like 813 to like 844 or something like that with the volume that you see there. All of a sudden, it just takes that liquidity and it just shoots up like crazy. In like 1 minute, you go through 50 points because these are the low volume nodes. It just has to break into those areas because it wants to find new liquidity where it can play around and accumulate a little bit and find buyers and sellers. And that's when buyers can come in. And if it's a lower, above, or below, you got to think as well. Falling knives, very, very difficult. So it can just keep crashing, keep crashing, keep crashing. But many days you sometimes see it. Once it hits the bottom low, at the end of the day, last 3 hours of the day, it still goes back up like 300 points. Crazy moves occur. And that's the reason of low volume nodes. And those low volume nodes are actually just like small, low volume nodes. Like there's just nothing there. There's no more orders. There's no stop losses. Some stupid stop losses here and there can trigger those. Plus, then there's nothing there to save it. Too much volume from the opposite side, like too many bears or too many bulls. And the market just keeps going until there's some kind of rebalancing. And that's one of those huge problems one sees here and there. And that's where breaks occur at the very beginning of it, and then the reactions are very sharp, and that's kind of the idea of a falling knife. That's why you don't want to get in too early with those, but those are some of the best trades one can truly have because you kind of want to trade. When it's low, you want to go high, or when you want to when it's low, you want to go long, and sell when it's very high up. And opposite way as well, if it's very high up, you want to kind of short it. So those are kind of the ideas. And usually the best ways to find those are IFEGs. There's certain confirmation on IFEGs that are very, very, very decisive, that have like an 86% probability that it will actually continue into those areas. And you can always just do little scalps, which I like kind of play with nowadays more and more. You go for like 3 points compared to negative risk to reward. 3 points if you just want to make money on a daily with certain strategies, prop firm wise, go for a few prop firms just with that strategy. You make $60 per trade, let's say, or you go 3 contracts, that's $180 per trade. 5 contracts would be $300 per trade. 3 points or 5 points or 10 points is usually the best. So let's go 5 contracts, 10 points is $1,000, and you're done for a day. All you have to do is be extremely correct about it and start playing that game correctly over time. And yeah, that's kind of one of the better strategies I personally like to play with, but it's very, very, very dangerous because sometimes it can go against you for small fake out. But to be in the market for a certain amount of time during the day, you have to be pretty unlucky for like those moves that you might have seen online already. The market all of a sudden is like for 1 second wicks downwards, 1,000 points or whatever, or a few hundred points, like that Bitcoin buy for 28,000 a few years ago, or like other random things in those ways that just are 1 second trades. You have to be pretty damn unlucky to get that quickly liquidated from something that is not actually your fault for making that trade. Of course, there's many fake outs, but you can actually catch a fake out if you believe it is a fake out, just for things like slippage or slippage and those things, those kind of trades. I understand how those mistakes can occur, but you sometimes have to calculate those in as well. Acceptance versus rejection. Acceptance shows agreement, rejection shows refusal. Volume confirms acceptance, low volume confirms rejection. Time strengthens confirmation. Structure aligns with volume. Context defines outcomes. Volume and breakouts. These are super important, and that's kind of the biggest part about all of it. Volume confirms the legitimacy of the breakouts. Low volume breaks often fail. Acceptance must follow. Continuation requires commitment. Volume protects against traps. Patience improves execution. Also, when you see a breakout, let's say you draw a Dorito pattern, which actually does work quite a lot. There's a bear flag, bull flag, those kind of things, just a random Dorito. If it's supposed to go upwards or downwards, usually probability of it's like 63% that a bull flag will continue upwards and 63% that a bear flag will continue downwards. So in this kind of moment, you would see a little outbreak down to the opposite side, fake out. You're like, okay, I actually gotta get out of the trade. But if you've done it long enough, sometimes these guys stick to your guts, have a proper stop loss, and the market then all of a sudden goes into the opposite direction of what you really want it to do for a second, and then it will go all the way down. And those are kind of sometimes also these IFEG slash um, just huge reversal trades, where the market, for example, during CPI first pops up and then drops down 500 points after going up 100 points, or it eradicates most people at first. So you just kind of got to start stacking with smaller contracts rather than larger contract sizes, because it takes a lot of time. And then when it goes right, it goes very correctly. Volume and Z reversals. Reversals require exhaustion, volume fades at extremes, participation dries up, momentum weakens, structure begins to fail, volume confirms shift, and confirmation reduces the risk. Common volume mistakes: ignoring volume completely, treating volume as a signal, using volume without context, trading every spike, misreading low volume periods, overconfidence, and lack of patience. Patience is a huge, huge one too. Because once you see volume kind of coming into it, and actually the way I just explained the idea of that trading pattern before you actually have a complete confirmation that the trade is going to go one way during these Doritos, and you're playing inside that thing because you believe it's going to happen, it's almost not being patient enough. But it can play in your favor. You just have a little bit more drawdown. And if that is the kind of concept you want to run with, you have a stop loss in place. You think, okay, slowly I'm going to place this trade. 5, 10 more minutes go by, and that's when the actual perfect patient trader would have done it. It's a little bit better and a little bit safer, but sometimes it does work in your favor. And being too hard on yourself, if the strategy is not exactly perfect with every single trade, then yeah, that's not really the idea of trading, at least retail trading. Professional, like trading at a bank, is also very, very different. Entries are very different. All those things are different. You're dealing with billions and billions of dollars. So you usually go for the very much long term rather than being done after one day. And you want to actually get smaller, quick trades in there with proper risk management. That's the only thing that actually puts you in that category. If you're looking for a few trades here and there, and you put in smaller contracts, and your risk to reward on those plays is quite lower compared to one that you're like 100% A plus setup with. So then the market goes up 10 points, but you know 100% is going to go up 10 points. You can drop in 10 contracts, and those 10 points would be worth $2,000. Now you could have another setup where you think it's going to go up 200 points, but you're not exactly certain, and the downside's a little bit worse. So you can calculate that. Those 10 points would be 100 points of one contract, and that would be $2,000. So you can just be smart with your risk management when you have huge, huge trades in those kind of ways. That's the actual way to actually maximize your profits over time. Institutional view. Institutions watch participation, volume confirms execution quality, size requires liquidity, acceptance matters more than price, execution is measured, volume guides decisions, logic replaces impulses. Volume and practice: identify acceptance zones, observe reactions at HVNs, watch speed through LVNs, align volume from structure, time filters reliability, liquidity adds confirmation, execution becomes clearer. That's kind of what I mean by that. Key takeaways: volume reveals truth, participation defines reliability, HVNs, the high volume nodes, and low volume nodes show either acceptance or rejection of a certain area. Volume confirms intent, context is essential in these kind of areas, and depth improves precision. Okay, perfect. Now we're going to VWAPs in different chapters. So we could either keep in this one, but I'm going to go through a series. So this was this chapter about volume tells you the truth of the market. So I hope you guys enjoyed, and now on to the next chapter.